We'll talk about those two developments with Bob Nardelli, which will be interesting, Jared, to hear about Walmart. For more on the markets, let's bring in Ryan Detrick, the LPL Financial Chief Market Strategist. Good to see you, sir. So let's talk about some of the optimism that comes from what Jerome Powell said, that it is very challenging, but it is a healthy economy. He still believes we'll have a soft-ish landing, and not entirely clear what he means by soft-ish. Sounds like you're optimistic.
Yeah, Jerome Powell, I think, is covering his bases there. I don't think he said anything that caught us off guard, but like Jared just talked about, buyers are stepping in this afternoon. I mean, let's not forget, though, where we are, right? S&P down 6 weeks in a row, hadn't been down 7 weeks in a row for like 20 years. So we know we're awfully oversold here. Then you come in today and you've got industrial production pretty solid. You got retail sales pretty solid. You know, things aren't perfect, but we just think so much of this negativity that is priced in after this, near bear market. I mean, we could go or flirt with bear market on the S&P, median stock down like 25%. So you're almost in a bear market. It's just a little overboard for us. And we think, this very well could be an opportunity for longer term investors here.
And we have had guests say, look, this is the time to perhaps get your shopping list together. If you were to get your shopping list together, based on historically how you've seen the market react after these corrections, what would be on it?
Yeah, well, there's what's the old saying, right? The stock market's the only place things go on sale and everyone runs out of the store screaming. So, things are on sale here. We almost take like a two-pronged approach here. Who brought you to the dance? I mean, you just mentioned, some of the materials are doing well, some energy's doing well. I mean, those two groups you like, but the other side of things, that's kind of your cyclical value. The other side of things, I mean, tech, right? We're more neutral tech. But I'll tell you, the second half of this year, if yields start to go lower, the economy can pick up. We finally have some good news. I mean, these tech names have just been obliterated. We all understand that. But the second half of this year, we think tech could be a group that could do well. And, don't forget how strong and influential that group is. So those are have a two-pronged approach that we think makes a lot of sense here.
Ryan, let's take a look at the retail sales number because it was strong once again in April, the fourth month in a row that we've seen an increase in retail spending. Do you think we're making too much of the fact that obviously inflation is a huge deal, but maybe the consumer is simply more resilient than we had anticipated?
Great point. I mean, we've said for a while the U.S. consumer is one of the linchpin, right, of the largest economy in the world, makes up about 70% of GDP. So this is just one example. I mean, let's not forget on Friday, we're talking about the Michigan consumer confidence number coming in, I think, about the lowest in about 10 years. So, consumers are saying one thing, but they're kind of doing another. And that's why it's so important to pay attention to what they're doing. I mean, things aren't perfect. Let's make that very clear. But with the consumer, they're still in awfully good shape. I mean, balance sheets are healthy, spending is strong. We all know the employment backdrop is relatively strong as well. If you want to get a higher paying job, this is one of the best times in a couple generations to go do that. So, the consumer still looks good to us. And that's one of the main reasons, honestly, we don't see a recession in 2022. I know some people do, but we look at the consumer as strong, with some of the other things we've been seeing. And it just makes sense that, this is a mid-cycle slowdown a la 94 kind of. We just don't see us head into a recession here.
It sure is nice to hear some optimism, and we will take it. You tweeted about a BOA fund manager survey, which shows the most cash on the sidelines since 9/11, indicating what?
That's right. I mean, it's cliche to say, right, cash on the sideline. How many times you guys had someone on a show the last few years talk about it? But it's true. When you look at the Bank of America Global Fund Manager Survey, kind of a mouthful there is a lot of cash, right? And it makes sense. I mean, stocks have done poorly. We all know the scary headlines, but there really is a lot of money that could come back into this market soon. I mean, retail investors, they've been banged up, right? They've got a lot of cash also. So this is just one contrarian indicator. Put to call ratios are high. Various sentiment polls are flashing levels. We've seen at major market lows going back the last couple of decades. So, all these things together suggest expectations are so low. From a contrarian point of view, if we can get any good news, and maybe that good news could be, hey, instead of 10 hikes this year, it's like 7 or 8. That's not necessarily a dovish pivot in our opinion, but maybe that could be some good news with the economy that can keep growing, that all that money can come back, not all that money, but a lot of that money can come back and likely push stocks a good deal higher the second half of this year.
And we did see a lot of retail investors panicking when they did see especially a lot of these tech stocks start to go down. If you're a retail investor and you're wondering what to make of this, do you buy the dip and what sort of strategy do you use? What advice would you give them?
Yeah, I guess it always depends on the time frame, but for your average investor, I mean, when you look back at history, guys, if you don't have a recession, right? You rarely have stocks down more than 20%. We had like 1978, you had 98, you had 2011 and 2018. S&P pulled back 19%. All those times you did not have a recession. If you have a recession, yeah, all bets are off. Things can get worse. The only time in the last 50 years we've had a pure bear market down more than 20% was in 87. Okay. So again, if you're not in a recession, we just pulled back 18% on the S&P. For your average investor listening, things are scary. But if you're not in a recession, like we don't see happening, this could be a time to remember to dollar cost average in, continue to invest for the long run, because again, stocks will likely be a good deal higher 6 to 12 months from now. That's what people need to remember.
So Ryan, given that outlook, do you think it's fair to say, do you think we have seen the bottom, at least for now?
Yeah, for now we do. I mean, we wouldn't be shocked at all if there was some type of a little summer rally. I mean, what we saw last Thursday, the last hour, and then Friday's continuation, and cross our fingers, today's continuation. This very well could be a multi-week, maybe a multi-month bounce. Do not forget this, though. Midterm years are very volatile. I think we can check that off. They tend to form the ultimate bottom late August, September. So maybe we can go back down and retest this. But for the near term, we think a well-deserved bounce from historically oversold levels makes a lot of sense. But we don't think we're going to just crash right through there. Maybe we retest them. And that, again, from an investor's point of view, is looking for several years out. This is a good time to continue to add, even on more weakness, continue to add here.
Certainly some refreshing optimism there. We do appreciate you joining us today. Ryan Detrick there, LPL Financial's Chief Market Strategist. Thank you so much.